Mr. Hanna, you're able to do drugs during the day and still function, still do your job?
Well, how the fuck else would you do this job? Cocaine and hookers, my friend.
Good morning or good afternoon. Anyway, good day. It depends on when you are tuning in for this one. So welcome back for another weekly market recap at the end of a week, which was quite uneventful from a price action standpoint. I mean, there were a few dynamics here and there which were particularly interesting to look at, and we're going to look at them later on. But all in all, the economic calendar was pretty light, not a lot, if anything. And the week was dominated by what? Sure, the usual talks about a deal in the Middle East. Then we got Warsh actually taking office. I think it's now officially confirmed. And yeah, I mean, the internet went crazy about this Elon Musk SpaceX IPO, which for me, I would be very, very skeptical on that one. But that may be a topic for another day. So without further ado, let's get rid of the economic calendar because, we got what? Basically, the only thing I was interested in, it was the Michigan consumer sentiment data point, which was a new low over the last 10 years. So, not cool. And, if you look and you zoom out using the Fred database website, what you see is that, sure, when we are so low, historically getting back to the 80s, so good chunk of time span, 45 years, more or less, all these reads preceded a recession. Now, the caveat, of course, is that these gray bars, which are basically indicating the recessions, yeah, they are printed maybe a few months down the road. The recession is always announced after the fact. So is it really helpful? I don't know, maybe not. And even in this case, if you think about 2022, right? The major recession scare, the market was drifting lower for the majority of the year up until October, I think. Did we have a recession? No, in the end, we didn't. I mean, some may argue it did. Someone would say, no, we didn't. So, very, very, very controversial. But nonetheless, that's the data. I think, sure, at a point, consumer sentiment is going to impact the economy because, again, the US economy, it's 67, but let's round it up to 70% consumer or consumption driven. So if you throw a branch in the wheels of consumers, they're going to do what? Stop spending, less demand, aka less revenues, less earnings growth, and even the stock market at a point should feel the pain. But are we there yet? Probably not. I mean, if you look at how the market is trading, you could argue, I think, maybe the stock market didn't get the memo yet, but when they get it, it's going to be violent. Sure, possibly. The other camp would argue against it, saying, well, sure, maybe the consumer is not feeling particularly happy, and it may give up, sure, but we still have those 4 or 5 companies in the S&P which are throwing something like 700 billions in investments for the AI buildup. And again, every single dollar spent in that type of investment statistically should return you $4. So the ratio of economic growth generated from these things should be massive, and therefore it could help offsetting the bad feelings and potentially the bad future behavior of consumers. Will it be enough over a long enough period of time to offset it? Probably not, especially because at a point you are gonna finish building up the entire thing. So, but again, it's not, people think about these AI build out as it was just about data center. It's not just about those. There are a lot of things when you start to build up these things. It's the structure itself, sure, but then you put in motion a lot of other industries from, the commodities you need, the utilities, the infrastructure, so roads, bridges, and then most likely around these data centers, you will have a development of some sort of a small town. So maybe houses, restaurants, to serve all those people which are living there, so more services. So it's a huge thing if you think about that, and probably this investment cycle will last for a few months, if not years. So Are we at the end of that yet? Maybe not. So, again, it's hard to be full on bearish on the economy, let alone the markets for a minute. We do know markets and the economy are not always going hand in hand. Actually, sometimes it looks like they are massively decorrelated or inversely correlated. But, there is a lot to put in the mix in order to say, oh, well, we are doomed for a recession in the next quarter or over the next 6 months. I've been hearing these calls for like 2-3 years now, and it never came. So, when it will come, you will know, right? So just wait for it, but don't try to call it in advance, because not only the economy being somewhat resilient, right, proved you wrong, but the markets proved you wrong as well. So, it's a difficult call, I guess, like calling tops and bottoms. Other than that, we got what? Inflation data, so usual 10-year break-evens, 5-year break-evens. And I put all on the same chart, even the 5-year forward inflation expectations. And again, what we see is that they pulled back a bit this week. Still, we have what? The 5-year being above the 10-year. So that alone should tell you that even if the market is trying to price in potential inflation down the road, it may be temporary. Because, 5-year, of course, is a shorter period than 10 years, right? So the market is saying, yeah, maybe in the short to medium term, we may have a little bit of a sticky inflation because of whatever, energy, the Middle East, the crisis, whatever. And I would add, also growth, right? But then, after that, we don't see over a long enough period of time, and again, 10 years, we don't see the same degree of inflationary pressures. And if you look at the 5-year forward, right, in isolation, if we can, let's try to do, you see that, it's not really breaking highs, right? If you just look at that, over the span of the last 2 years and something. We are not really running away as for the data point reads. So are we doomed for another, inflation spike as we've seen in the past, 8-9% CPI? The market is not pricing that in. So if it's going to come, it may be a huge surprise. So, therefore, even a much more, a much bigger headwind on potential asset prices, performances, and returns, right? As for the rest, CPI, as measured by Truflation, climbed back up to 2%, and PCE, it's currently at 2.5%. We are going to have new PCE data next week, so we'll see how the official data are coming in. There was a little bit of a shift, even on the FedWatch tool. You see that now for the next meeting, right, now we have a tiny little percentage of odds priced in for a rate hike. I don't think they're going to hike at the next meeting. It's going to be the first Warsh meeting and press conference, so I don't think he wants to come in hiking rates. But, that's what the market is pricing in. So we'll see about that. But I think, we still have 3 weeks before the meeting. So it could change a lot, right? Credit spreads still on the floor, nothing new here, no risk priced in for now. So we are still good on that side. And after that, I think there is really nothing else to be discussed as for what came in this week. As I said, next week it may be a bit more funny, if you wish, from the economic kind of standpoint. But beside PCE, I don't think we're going to have a lot of different things impacting the market, right? Maybe GDP growth rate, it could be one of those which could. Also personal income, why not? Yeah, so probably the majority of the movement generated by these news will be on Thursday. So, just keep an eye out for that, all right? So let's jump into the charts instead. As for the charts, let's start out with the DXY. Nothing new here. The market was particularly steady throughout the week. I mean, it went up, it went down, it went up, down. So just a consolidation. I mean, still, at the very end of the day, considering that the week opened up in here, right, on Monday, and it closed basically at the same level. So if you zoom out on a weekly time frame, what do you have? Some sort of a doji at the end of the day to testify that the market didn't really go anywhere this week. All right. So what next? I mean, I think we still have the potential for a further push up. Now, the thing may be, is it going to be another sharp move, another leg up like we've seen here? Or are we just going to grind higher and higher? My bet would be on the grind. You know, if we don't have some sort of an event or a shocking piece of news, I don't think we're going to have another, you know, a leg like this, like 1, 2, 3 days or up only. But, you know, I've been wrong in the past, so who knows, right? And downside risk for the DXY. The downside risk may happen if we have some sort of a actual announcement of an agreement in the Middle East with oil prices tanking throughout the week, let's say getting down like 15, 20 bucks. And at that point, since at this point, if you notice the DXY, so the relative strength of the dollar and energy prices are pretty much correlated, I would expect the DXY as well to come down a bit. So that would be my bearish case for next week. Now, again, you may say, how can it be? I mean, oil is a commodity, right? Nat gas is a commodity, right? So if the DXY goes up, they should be going down. They are priced in dollars, right? And vice versa. If the DXY goes down, those commodities should go up. I mean, historically that was true, but I do also think you have to somehow draw a line at a point in time where the US transitioned from being a net importer and consumer of energy commodities to the point where it started to be a net producer and exporter of energy commodities. All right. So I think it's playing a role, that phenomenon there is playing a role as well. So this is why I would think that probably there is today a bit more of a correlation, or, you know, at the very least, less, if you want to look at the other side, less inverse correlation in the DXY, aka the dollar strength, and energy commodities price. All right. So I would leave it at that for now without digging any further, because I just want to keep the video a bit shorter than usual, since not a lot did happen from a price action standpoint. So let's have a look at the currencies. Now, as we were saying, the euro and the pound, they were both coming into expected support. Now, the bounce in the euro was pretty anemic compared to what we've seen in the British pound. Nonetheless, there was at least a little bit of a slowdown in here and a decisive bounce. I mean, in the context of this price segment right here in the British pound. So I guess the advice was kind of good. Pay attention. Don't try to short support. And yeah, after that, nothing else. They didn't really move a lot. All right. The Japanese yen kept on drifting lower. So, you know, yeah, interventions, this and that. But at the end of the day, the market is speaking differently for now. But even in this one, nothing conclusive. I mean, again, it could very well be that we find a little bit of support in here. Although the case for a sharp bounce from this region, kind of like what we've seen in here, it would have been much stronger, in my view, if we would have crashed back into it, rather than, as we are doing this week, drifting into it. Like, if you see at the difference, look at how price came back down into the level which was created when the intervention was made, right? And the type of bounce we had, and look at how price is coming back into it right now. I don't think it's going to generate the same bounce by the look of it and the way it's drifting back into it. So, you know, probably, yeah, we are slowing down, getting near it, but I wouldn't expect at this point the same type of reaction we've seen here. At least, that's the expectation. Of course, it could happen, obviously, which is why, same as last week for the euro and the pound, be very careful in shorting ahead of what you may deem as anticipated support, right? But, after that, just assess the reaction when it comes, right? Canadian dollar, it's at this point, it's just boxed in this wide range in here. So if you zoom out a bit, in between this point of release, which marked this huge and important high back in 2023, and essentially the level of support we established to the downside. So we are kind of trapped in this bottom right here and the old high right there. Or, back in time on the left, you've seen it, right? So still going around in this huge dealing range for now. Swiss franc, it's just, again, kind of the same, but instead of being some sort of a rectangle or a horizontal channel, we are seeing some sort of a contraction in here. So again, it's still consolidating, but in a different way, if you wish, right? The other currencies, let's try to be quick. South African rand, nothing really changed. Still, this contraction. And as we said last week, you could think about it as a reaccumulation up until the point the trend line is not broken. Okay, all right. And other than that, nothing really changed. Brazilian real, kind of like the DXY, it stayed stable. Like if you invert the chart, right, it's kind of the same behavior of the DXY. We kind of, in this case, we broke some sort of an important one or two lows, important for the structure to the upside, and we weren't able to reclaim them. So we are just leaving and drifting below them now. So probably, a little bit of a short-term weakness in this one, but overall, the trend, look at the trend, it's still up. So shorts should be short-lived if you want to take them. So don't, overstay your welcome there. Russian ruble still going up. Australian dollar, nothing new, consolidating. Same as there's nothing new in the Indian rupee. Yeah, a little bit of a bounce Thursday and Friday, but the rest of the week was down, and we are just keep on going down and down in this one. Chinese yuan is going up, which again, if you zoom out, look, it's been going up for a while now, right? Basically 1 year. This is April 2025 here, when we put in the lows, right? So which are the implications of that? Now, first of all, you can read it twofold, right? On one side, you may say, if it is true that overall China is a net importer of energy, yeah, I know they got a lot of nuclear power plants. Sure, they invested a lot, and rightfully so. They are smart, right? But they are still importing nat gas, oil, and a lot of different things they need. All right. So if their currency is going up against the US dollar and all of these commodities are priced in dollars, they should be, a bit more protected toward the energy crisis that we are looking at. That is true. On the other side, though, you need to think about China and the economic model China has. They basically produce a lot and they try to dump all their goods on the rest of the world. So, if their local currency is appreciating against the dollar, it means that those goods are, a bit less cheaper compared to what they were 1 year ago. And incidentally enough, it may be coincidence, right? But if you check what happened in retail sales in China, they collapsed, right? We are talking about China, so you need to think about the things in context. But this type of read right here, it's not something you see every day. And it looks like, over the last year, we started to see it more and more, starting in June 2025. So is it a coincidence that in April 2025, the Chinese yuan against the US dollar put in a low, and from there, we started to see a little bit of difficulties in retail sales? Now, sure, a lot of that needs to be taken in the context of what's happening in China domestically, but, nonetheless, even if you look at year over year, right? These are very low reads, if you think about that. and it's slowing down again. Since when? April, and then May 2025, there was the peak, or at least the recent peak, and then it started to drift lower. So, I think there is a little bit of a connection there. Maybe not huge. Obviously, there should be other factors involved, but nonetheless, I think you can try to create or to look for a link there in between the two things. I think they go hand in hand to some degree, right? Now, enough for currencies. Let's have a look at Bitcoin, which sadly looks like it's about to give in. So we were looking at this level, right, last week. And, last Saturday when I was recording, price action was already in here. So we closed below on Saturday. We kept on going down on Sunday. It's 24/7 market at the end of the day. And the week was what? Monday, Tuesday down, a little bit of a bounce throughout Wednesday, Thursday. Thursday, doji, aka we started a reversal. It's always that Thursday, right? And then Friday, massive drop. So we are, we're right there. I mean, if we do take out this low and close below it, what's going to happen next? It's weakness, right? The case was, look, you need to maintain this level, first and foremost. If you lose it, you have one last chance to maintain the structure intact in here. If it doesn't happen, well, then at that point, you need to, again, to shift from bullish to most likely bearish. So, the progression of things would have been bullish in this segment. Oh, lower highs. See that? Now we break below this level. Okay, so we should shift at least to neutral and hope that we're accumulating there. We reclaim the level once again and we start to push higher, all right? If it doesn't happen and we take out this level, now at this point we should be bearish because we structurally change the behavior, right? So we'll see. I mean, the day is not closed yet. And I think, we may see a little bit of a stitch up. Like it could be maybe we actually close below the level and then we have some sort of a pullback and we see if we have continuation after that. But sure, not defending this deep swing low right here, it's not an encouraging sign for Bitcoin going forward. So at this point, should be neutral, aka bearish, depending on how and when we do take this low right here. Can we still save it? Technically, we could. I mean, it's not closed below until it's closed below, but I mean, I don't really like it. Right? So, this position would be bearish, of course, especially because of this huge bearish close on a Friday for the regular trading week. So, yeah, that would be it. Now, again, how do you know this is saved? Well, of course, you need to start doing something like you were doing before. So, take this high, for instance, right? So, you would need to do what? Try to save these. Trading above this high and then resuming the uptrend mainly, which at this point it looks very difficult to do, especially because price action is drifting lower as I speak. So, doesn't look encouraging again. And that would be it for Bitcoin, right? Now, again, gold instead didn't move a lot this week. I mean, we were talking about the weakness in gold and, this area being depleted more and more. At the end of the day, yeah, there was weakness, but we did also say, well, look, but up until the point it's not broken. And, we kind of held overall at the same level. Although, as you can see, we are keep on pushing down into it. And every single time, the reaction, it's, weaker and weaker. So, again, it's kind of like the yen talks, right? It's not the sharp drop into a level, which you deem as support, that you should fear. It's the drift into the level. Because it means that on one side, there is always less and less liquidity on the side of the buyers to sustain price, right? And on the other side, it means that the sellers are getting more and more conviction into, in selling this market. So I'm I'm still of the same view as of last week. Nothing really changed this week for me in gold. And I was reading, I mean, I don't have the article right here, right now, but I was reading on Zero Edge. Countries, and you know, the example was made with Turkey. I think it was Turkey. And not only they sold off a lot of their gold reserves over the last period, right? Now they're starting to sell treasuries, right? And again, you may say, but if the world is trying to diversify, right, trying to run away from U.S. treasuries in order to not be, subject to potential U.S. sanctions and, not be able to do what you want, because if you do something that the U.S. don't like, you may be sanctioned, right? And then why would they completely run down their gold reserves? Well, to defend their local currency, the Turkish lira, right? Because at a point, you need to have priorities. What's more important? Hedging yourself toward some potential future disagreement with the US, or protecting your currency, which is, collapsing now. And you need that currency to at least be, I don't want to say strong, but, not collapsing, because otherwise you're going to suffer a huge double, punch. Oil just went up like 50%. If at the same time your local currency is going down 30, 40, 50%, and you need dollars to acquire oil, right? You are getting the worst of both worlds. So you can't really do anything about the price of oil, but at least you can try to save your currency, right? So I think, it could be another reason why a lot of countries, especially, these emerging markets, these countries in Asia, like could be Philippines, could be Indonesia, could be India, right? They're selling a lot. Actually, I was also reading India trying to put a ban on gold imports, because they don't want their dollars, since again, gold is another thing which is, for the majority, right, it's priced in dollars. You need dollars to buy gold. So they're putting a ban on gold imports to do what? To prevent those dollars to flow into gold, because they think that maybe they need those dollars to do what? To buy energy. At a time when, again, their local currency is doing what? It's been cream pied. So, it's a dollar world, whether you like it or not. Yeah, sure, gold, Bitcoin, all cool things. Shit. I mean, I went away for what? 2 minutes? Could be a very violent weekend for Bitcoin, maybe. Although, I mean, it's still, what? Not even 10 a.m. on a Saturday morning, but doesn't look cool, man. But again, let's get back on track. That's the thing with gold. Weakness, potentially if we keep on drifting lower at a point, as I was saying, I think 4,200, 4,100 are still in the cards for a potential pullback, right? The other metals was basically the same, like silver, again, tested into the level, right? As you can see, last Friday closing here at support. But again, Monday, little bit of a, bounce, and then Tuesday pushing down. I mean, if you think about these, right, in the context of this sort of uptrend, right, you could think about these price segment, this box right here, where my mouse is, right? You could think about it both as a shelf. Price is going up, it's creating a shelf, and then it's using it as a launch pad for new highs. Or, if you're just looking at this swing up and then down in isolation, that could be your base, if you think about the model for a price swing, right? Whichever the case, we tested the upper side of the base / shelf. Then we pushed deeper into it. So we tested base, shelf top, base, shelf bottom. And again, every single time we didn't have a bounce huge enough to create new highs in the context of this short-term price action segment. So weakness even in there, although again, the area, it's not fully depleted yet, but it looks like it may be soon. So again, kind of like in gold, I would be a bit more on the neutral but more bearish side for metals in general. I mean, if you look at palladium, it looks like a completed redistribution now, right? Bounce, another tiny bounce, and we are back at the recent lows. Platinum, it's still in this range, right? Still above this high, but below, above these lows, but below this high. And we had this swing failure pattern right here. Market pushed through, closed below, and immediately moved away from it. So probably another test of the lows should be in the cards. The only one metal, for obvious reasons, mostly fundamentals, which is holding up relatively well, it's copper. And again, we hinted at that when we were talking about consumer sentiment, economy, recession risk, and all the rest. What do you need to build up? Basically whatever today, right? Whatever has to do with electronics, you need copper, right? So, copper is still up because there is a huge demand for copper. And so I would say, if anything, at least copper as a fundamental reason to stay up. And the price structure, it's pretty much bullish yet. Now you may say, well, but even silver has a fundamental reason because it's used in many different industrial processes, right? Even for solar panels and whatnot. Yeah, it is. But, it is also true, I was reading that that was mainly brought up when silver was running like crazy in here, right? They were discussing the possibility that, silver is nice to be used in solar panels, but if the price of silver goes up so much, you could substitute that with what? With copper. Although they don't have the same effectiveness, but, if you start to run the math of effectiveness versus the costs, there is a point where it's better to use copper, although it's yielding you less from an industrial standpoint, but at least it allows you to keep the costs down, right? So, if you start to factor in all the things, not only the yield on the material, right, in the process industrially, but the fact that the price of one, which would be the favorite one to be used, right? But if it's costing you too much, at a point you try to look for alternatives, which are not quite effective, but at least they don't cost as much, and they allow you to keep prices low enough that you can still sell out those solar panels. Because you could build up the best solar panels in the world, but if they're out of market because there is no buyer which is willing to buy them at such high prices, doesn't make a difference if they are the best, if no one can afford them, right? Now, let's have a look instead at oil, which, surprise, surprise, came back down into what? Into the 95s. So 95s, basically, which is, again, what? Kind of the EQ of the range, right? Try to bounce in the last 2 hours of the week. If we zoom out a little bit, could still say there is now some sort of a trend line in here, so higher for longer, but there is a trend line also in here, so lower lows. Lower highs, lower lows, still consolidating, right? Now I do know if you back adjust the chart, it's even more bullish, right? It would be like that, essentially. So, yeah. You still have the same trend lines, right? If you try to adjust them a little bit. But obviously, it looks more bullish if you look at it on a back adjusted chart. So I think it's a matter of preference, maybe. I usually don't look at things on a back adjusted base, which, again, may be my own limitation. Maybe I'm doing things wrong, possibly. I'm totally open to that possibility. But at the end of the day, I don't trade in such, medium-term scopes. I just trade from one day to the next. So I don't really care about back adjusting things, right? Although, again, I do understand the logic of it. And I think there is credit in doing that. Absolutely. It's just not my thing, right? So, all in all, probably, a lot of what we are going to see in oil will be, tied with what's going to happen this weekend. Because, we are going to see if this huge optimism that we are seeing in these Middle East peace talks, it's going to be rewarded or not. Last few times, it wasn't, right? But who knows? Never say never. It looks this time around, there is consensus coming from many different angles, right? So, it's all up in the air for now. I would tend to think that up until the point I don't see it, I won't believe it. Because, we have been talking about the war is over, the war is won for 2 months now, and, nothing really changed. So, again, for me, it's always the same. Up until the point we are above the EQ, I still see it as bullish. If we can crack below it, and potentially cracking below the 85, at that point, I might say, you know what? This could be the market actually finally acknowledging the fact that, the war is actually over, there is an agreement, and most likely there will be some sort of resolution on the Strait of Hormuz. Although, again, just remember, just because they sign a piece of paper now, in order to get back to normal levels of both transit and actual commodities, aka gas and oil, getting out of the strait and getting to the destinations they are supposed to get, it's going to take a while, probably a month, right? If not more than that. Just accounting for the time that a ship need to travel, right, in order to get from the Middle East to, I don't know, Southeast Asia, Europe, or whatever, North America, we are talking sometimes weeks of navigation. So if we open back the strait now, well, maybe we are going to get that oil in 2 weeks. If you think about maybe Australia, right? That they're going to look at that like this. So who knows? On the other side, it's also true that there was a lot of supply being blocked, right? Just hovering over the water. So after that period of navigation, you're going to have new supply all at once getting to where it needs to be taken. So we could actually see the market pricing in a little bit of relief in the energy prices. But again, it's the weekend. They've been talking a lot for weeks now. And of course, there is this role play where one side is saying one thing, the other side is denying. So, which is why I always default back to, look, I don't need to be a fortune teller, right? To know if there is actually an agreement or not. The market will tell me, right? Just look at the price action. Let the money speak, all right? I would trust the market more than what I'm trusting the claims or declarations by the IRGC or even President Trump, right? They're both trying to spin their own narrative for their own reasons, which, they are legit, right? From both sides. Both are trying to obtain an objective and to fulfill some goals. So, that they're using narratives and propaganda the way they see fit. It's normal in every single war. I'm not saying it's a crime. I'm not saying it's bad or good. I'm just saying this is the way it is, right? And I don't care whoever is doing it. If it is the mullah in the Middle East or if it is President Trump, they're both playing the same game. It's a war at the end of the day. So I'm gonna let the market speak, right? Now, tied to these yields, they had a little bit of a rally in the short end, as you can see, even this week. Although the 10-year and the long bond, as for the yields, they kind of pulled back a little bit. Now, what about it? They pulled back because they were massively extended to the upside, I think. I wouldn't read a lot in what happened this week. And of course, you may say, sure, they pulled back because of these talks in the Middle East. So what's going to happen? The market will start to price in the potential resolution of the conflict and the reopening of the Strait of Hormuz ahead of time, right? And inflation expectations should do what? Come back lower, aka yield at the medium and long end of the curve should come back lower. Incidentally enough, you now have a divergence in the opposite direction. For a long time, right, we were looking at, the medium and long end going up, while the short end was staying kind of muted. And now instead, this week, it looks like the short end kept on pushing highs, while, the rest of the curve came back down a notch. So, again, if you look at the futures for the different, your T-note, your 10-year, and your long bond, they basically behave the same, right? Now, also bear in mind that there is always when it comes down to the movement of the underlying, so the asset relative to the yield, there is always that convexity problem, that convexity function, right? Because of the duration, different durations, right? So, it could be that as well. If you noticed a little bit of a much more volatility in the long duration bonds relative to the short duration bonds, right? So always remember that. Other than that, what could it be? So, I know people are kind of scrambling around it. Is 10-year yield being above 4.5 yet? This is just the roof, which has been broken. So from here on out, it's going to be yields going to 6, 7, 8, 10%. Maybe not. For me, the question is always, can the economy actually sustain that degree of yields? I don't know. I would say, a good part of the economy couldn't, right? But overall, in aggregate, you could build up a case for, the economy as a whole to be able to do that. For how long? I don't know, right? But sure as hell, again, I wouldn't default back to the same topics of, yields are higher because nobody is willing anymore to buy the debt. Is it? Then, if that's the case, why are you looking at these when it comes down to foreigners holding US treasuries? You may say, okay, but the officials, right? They kind of stayed flat. Sure, and look at the private, right? Why? Sure, this week, I guess, it came down a tiny bit, but overall, if you look at the trend, the yellow part, right, is going up and up. Why would you think that's the case? Who may be this private official? Might be the banks, which again are playing these arbitrage for free money all across the globe, right? Because at the end of the day, a bank, it's buying treasuries with what? For you and me, it's different, right? I put my money into treasuries, right? I get what? 5% of yield every single year, sure. But what if real inflation is at 7%? I'm losing money. I'm losing 2% every single year of my purchasing power. Sure, that's true for me and you, right? What about a bank, though? A bank, it's basically collecting the same yield and it's suffering the same level of inflation. If there is inflation for me, it's going to be for everyone else, right? Although, again, inflation is subject to many different things. But, roughly speaking, if there is inflation for everyone, right? Banks, they do pay the bills, right? They do pay the electricity bills, right? Sure. The problem is the bank, it's buying with money which is not there. They're buying with my money and your money. You put money in your checking account, in your saving account. What do you think the bank is using to buy those treasuries and collect their yield? Your money, my money. So they are playing with money which are not out of the pocket. So it doesn't really matter if inflation is at 7, 8%. I'm still making 5% for free. So, it's a different topic when you start to look at that from the perspective of a bank. Now, sure, then again, if you look at the Atlanta Fed, what you see now, and again, these are estimates. It doesn't mean they're going to be confirmed, right? But they are pricing in for Q2 2026 GDP growth at 4.3. And this is where we get back to the usual topic. Is, yields impacted more by debt and deficit or by inflation expectations and economic growth? If you think economic growth is going to be at 4.3, the 10-year, it's basically where it should be. 4.3 plus a little bit of a premium, 4.5. So again, who's right and who's wrong, right? And again, are we back in the same scenario we were in the 1970s? Maybe, maybe not, but I mean, these are a few differences, all right, for the stagflation. I mean, a few things may reflect the same type of risk, but I'm not going to read it all. You can just pause and read it yourself. But there are a lot of underlying fundamental and structural differences in between the situation we were in back then and the situation we are in now. So saying that just because you're looking at your favorite YouTuber and he's saying that he's going to be absolutely right, I mean, did he check all the different factors and dynamics at play in here? Because when you do, I'm not saying you should completely change your view, but at least you may get some help in assessing the overall scenario when it comes down to placing more odds or less odds on one thing happening over the other. And again, I think, if you think about stagflation, what's stagflation? Higher inflation, lower economic growth, lower employment. But if we have lower economic growth and lower employment, aka lower wages, aka less demand, less consumption, where is inflation coming from if you don't have people spending or the economy growing? Which is why I think stagflation cannot be sustained for a long enough period of time. Because at a point, the deflation part of the stagflation, it's going to be, defeated by people not having enough money to keep on beating prices higher and higher. So, maybe it's just me, but I'm more, I tend more toward that type of analysis rather than this is the end, the depth, the Ray Dalio, the Lucrum, and the whatever, the Paul Tudor Jones, which same guys which have been wrong about this for 45 years are now telling you that, well, this time around, this is the time, right? It doesn't matter. I was wrong for 50 years almost, but, this time around, yeah. The irony would be that the thing will actually happen when they all pass away. Oh, well, I've been wrong my entire life, but I was right after I was dead. So does it make a difference? It should if you're dead, but who cares, right? The legacy, right? All right. Now, okay, this is more than enough for the first part of charts. So let's try to dive in what happened into the stock market, which at the end of the day, in my view, was the most interesting segment of the week as for the price action. All right, so as for the stock market this week, I mean, if you look at the heat map, you see that we had mixed bag results. What catches the eye, of course, is Nvidia being down 6%. To some degree, even Google. I wouldn't be particularly worried over it. I mean, we are talking about, stocks which had very good runs, even recently. Nvidia reported earnings this week, and they were stellar. So, the stock was rallying into the earnings release. And I don't see anything worrying in the type of earnings they release. So I think it was just some sort of a sell the news event, okay? And, we had confirmation, all the worries about semiconductors being overextended and whatnot. Sure, and then you see Intel being up 9%, AMD almost 8%, Cisco 5%, and then what? Qualcomm 18%? Shit. What's that? Seagate 5%, Micron 2.5%. So, I mean, yeah, just a testimony that just when you think the market is overextended, well, it can always be more overextended. So, that's the thing with these, thematic frenzies sometimes. At the end of the day, if you look at the different sectors, the index was up, of course, all right? And, major contributors were utilities, healthcare, real estate, which it's something that we didn't see, right, occupying the top of the leaderboard, right? But, so it is. And you've seen going down well. I mean, it didn't go down, but, the contribution was way more muted. So energy, materials, and communication services. So at the end of the day, if you just look at the price action, what we see is this for the week. So the market, and we are now looking at both the indices that we usually look at. Although, I mean, the Dow for me, it's just it's a little bit of a barometer. I don't necessarily trade or look at the Dow constantly, but I just use it in the context to assess what the other two are doing, right? So it's here, but I don't really follow it that much, right? Okay. But Monday, pushed up right after the Asian session. So European session pushed up and it was some sort of a failure. So we came all the way back down and we started to make lows. Then again, come Tuesday, Asian session down, European open, little bit of a pullback and then down. Now this point, this Tuesday low was critical for the rest of the week. And we're going to look at that in isolation later on. But from here on out, as you can see, we bounced, we failed at continuing pushing lower. So naturally, we started to climb higher. Now, a lot of back and forth, right? The different days were particularly volatile, but the major expansions, right, came to the upside. At the end of the week, we closed on a little bit of weakness and, we didn't make new highs for both the NASDAQ and the S&P futures, which again, we are going to look, at the bigger picture in a moment. So what you see on a daily time frame is that, sure, we had these 1/2 days of a pullback, and we immediately tried to rally once again. Now, Friday's candle, it's not the most enthusiastic in my view, not only because we failed at new highs, but I mean, the shape of it, right? It looks a little bit like we tried to rally and we were rejected, right? For the others, the Russell is still in this range. I don't see anything new in this one. The Dow instead actually made, I think it made new highs. Yeah, sure, new all-time highs, although wasn't able to maintain them, right? Or was it? Barely, if it did. Oh, well, it looks like, on a closing base, yeah, it was. So the point for me would be this. Now, let's get back to that chart we were looking at last week. Now, we're going to use NQ just for the sake of it. But so this is essentially the change in behavior, right? Last week, we had that gap to the upside, which wasn't filled, right? And the market came back down. Now, this week, we had what? If you check, right, we just basically took out the previous weekly low, right? If you look at the previous week, from Monday, we just started in here, right? That was the weekly low last Tuesday. So we took that out. It was some sort of a look below and fail. We immediately came back up and starting to hold these levels. So, it was interesting because everything happened ahead of NVIDIA earnings, which would have been the following day, right? And again, I think it offered up a very good, level and, potential price behavior to anticipate what the rest of the week could have been. Now, this is from that specific day. You can check the date in here, May the 19th. Just, it was like 6 minutes ahead of the New York Open. And that was the assessment, right? I mean, what about this market now? Look, if we take out the previous weekly low and we sustain, we see the market being offered below it, and you can't really read it, but it's basically short on confirmed break, right? Meaning that we can expect lower prices. If we just look below and fail and we start to reclaim the same levels which brought us to, the raid of the lows, then try to long the reclaim, right? And, at the end of the day, it played out kind of nicely. I mean, if you zoom in, right, you can see in here, right, that basically that's what we did. This is, that's that segment below the push down in here. We raid the lows, we come back up, and we start to do what? To hold at those same levels in here. And then again, we push higher again. Look at this level right here, which I know it's hard to see, but it's basically around the London Open for that Tuesday, right? Which would be, if we zoom in, essentially in here, would be this level right here. these, which is, incidentally enough, where we do what? After the secondary push, this one, we pull back right into that level. And from there, it's game on. You know, the rest of the week, the market just moves up and up and up. So, you know, at the end of the day, we didn't make new highs. So, you know, that was the behavior, right? Both for NQ and, I mean, ES was the same, a bit more iffy in my view, because we had the initial test and then another one. So some sort of a double test. But at the very end of the day, we never saw that offer below the previous weekly low. And eventually, you know, the market resolved itself to the upside. So, you know, it was a nice way to try to assess what would have happened. And if we get back to the same type of, layout, which is really just looking at RTH rather than extended trading hours, but, you know, the fear for a potential change in behavior after Friday's price action, it was legit in the sense that at the end of the day, we didn't fill the gap immediately and we needed to come back all the way low, right, down, and took out a previous weekly low. And after that, we, at the end of the day, failure, and we kept on going higher. We eventually filled the gap completely, but we didn't make new high. Why this? I mean, it's important in the sense that at the very end of the day, it kind of confirmed the thesis for a potential change in behavior. Because if you get back in time, right, what you see is that, you know, the previous week, right, which started in here, did it take out a previous weekly low? No, because it would be right here, right? And this week, so the first week of May, did it take out a previous weekly low? No, because Monday opened in here, the low was on the same Monday, but the previous weekly low was down here, previous Tuesday, so no. What about this week, which opened in here, right? Did it take out the previous weekly low? That was the low for the week, and the previous weekly low was where? Here, right? So, you know, since basically the middle of April, which it's basically this, if you pay attention, it is from when we started, right? This massive rally pushing through new highs, right? In here, since where the push to new all-time highs started, we never, ever took out a previous weekly low. So it was a good call for a change in behavior. And incidentally enough, once we took that out, we didn't make new highs. So again, getting back to that same date in here, this is the first week where we don't make new highs compared to the previous week. So it's still changing behavior in the sense that, you know, I wanted to see what the market would have done Monday and especially Tuesday. We had our confirmation on Tuesday, which was essentially, well, okay, the market doesn't want to offer lower. And that's one thing. And now we had another piece of information on a Friday that doesn't want to push lower, but at the same time, at least for this week, didn't want to push higher. Again, NQ futures, but, you know, the S&P, it's basically the same, right? Weekly low, rated 2 times, no new highs. So what we can say about that now is that at the very least, right, up until the point we are told otherwise, the 2 main indices, they are boxed now in this new, you could call it this new balance, right? So from here on out, up until the point we are in this balance, we should consider it short-term neutral. If we break 2 new highs, then we are breaking out of what? Call it 1, 2, 3, 4, 5, 6, 7, 8, 9, could be 10, right? If we can break out of a 10-day balance, which is being established and confirmed now, or a 10 days range if you want it, right? Then again, we could start to think about this range was established, was broken to the upside, up we go, we could extend gains higher. If we break to the downside, now you can say, you know, high, kind of a lower low compared to previous week, right? And then fail at new highs. So if we break below this low and we offer below this range, we may see the start again of another, or a continuation of that changing behavior, right? Up until the point we are in here, we are just trading in this dealing range. So that would be the thing for now. So at the very end of the day, the call for a potential changing behavior was confirmed kind of right, in the sense that we didn't have a massive push to the upside, but not at the same time, we didn't have a massive pullback to the downside. So, let's see how we do trade in this balance. If we trade below Friday's lows, we might confirm for real price being stuck in this range. And it could be maybe for another week, who knows? But at least now we have boundaries to work off of, right? Sure, I mean, is it a massive problem? Like if you look at these, right, we are still above all the moving averages, right? We kind of dipped below the 8, sure, and then we immediately came back up above it. They're all still upward sloped, and they're all trending to the upside. It is true that the RSI is starting to print divergences. So even if we attempt to break for new highs, we are in danger of creating new divergences on the RSI, which again, if you pair it up with breadth, always slowing down, right, or narrowing down, it's still a testimony that the underlying structure of the market is getting thinner and thinner, aka weaker and weaker. So it's much more prone to be impacted negatively, but some sort of a headline news or a sudden negative development. All right. At the same time, we now have, I think for both, MACD printing a sell signal on the daily. Now, look, sell signals in this case doesn't necessarily mean that we are doomed for a pullback, right? It just means that upside could be limited. And let me find a good segment which could reflect this dynamic, just for the sake of it. Look at that, for instance. Look at this segment right here, which went from August 2025 up to October 2025. You see that the RSI right in here, price is going higher, right? But the RSI is going lower. So we are creating divergences, sure. We are operating on some sort of a sell signal on the MACD. And again, it doesn't mean that the market crashed or pulled back 10%. It just meant that, advances were much more difficult. The market wasn't moving sharply to the upside, but there was a lot of back and forth. Overall, if you zoom out and you start to look at things from the perspective of weeks, it kept on going higher, sure, but it was much more of a slow grind rather than sharp moves to the upside. So, that's the type of information I would gather out of that. The market will be in trouble, so to speak, when, sure, on one side, you keep on having the same sell signal on the MACD, the same divergences on the RSI, but when the trend actually shifts, right? So, moving averages starting to be downward sloped, the faster below the medium or the slower, and the market actually starting to break lows and breaking structure to the downside, which is categorically not what we are looking at right now. It could happen, sure, it could, but it's not happening now. So, again, it's very hard to be bearish this market. Because again, 2, maybe 3 days where the bears seems to have the ball in their court and they drop it. It sucks to be a bear, all right, I guess. Up until the point it doesn't, but for the majority of times, it sucks, right? And now again, if you zoom out on a weekly time frame, especially for the S&P, now we have 1, 2, 3, 4, 5, 6, 7, and now 8. So, the stats for 7 consecutive weekly closes at the very end of the day, if you want to look at things in the grand scheme of things, it just means that, after 4 weeks, 12 weeks, 26 weeks, more often than not, we should have positive returns out of the index as a whole. Sure, it doesn't tell you a lot about the single sectors, the individual sectors, but overall, the market should be positive. Can there be a bit of volatility in between? Sure, absolutely. And again, inflation risk and expectations, energy situation, midterm elections, geopolitics, many different things. But at least from a statistical standpoint, we do know that the market should be positive over the medium to long term. So, 2, 3 months, 6 months, or a year down the road. But we will need to assess those things in real time at the very end of the day. This is just a weekly recap. We're not trying to forecast what's going to happen next year. All right. What else? We could look at these. I mean, this is basically the margin debt expansion. Again, you could read it as a measurement of leverage in the market. And it's true that when leverage or margin debt reaches extremes, right, you tend to have downturns in the market. That's true. And, conversely, when it reaches extreme to the downside, you tend to have bottoms being formed in the market. Are we, for now, at below nose bleeding levels? Not yet, it looks like. I mean, we are starting to get to attention levels, but we are not there yet at extremes, right? So just to show that, sure, the market could get volatile a little bit. We may have a little bit of pullbacks here and there, especially headline-driven news and movements. But overall, at least this metric, it's not signaling an immediate danger, right? And then we were talking in the beginning of the video that one of the events of the week was Kevin Warsh actually swearing in and taking office. This is just for the sake of it, but it looks like we may have some turbulent times because historically that's what happens when a new Fed chair takes office. Now, it could be because there is a little bit of uncertainty on the policies that will be implemented with the new course at the Fed. Who knows? Some might say that it's the market trying to test the real intentions or actions of the new Fed chair. I know it sounds stupid, but let's take the recent one. So Warsh, he said that he doesn't believe in QE infinity, in balance sheet expansion, in rates being down to zero. Sure. So it could also be, the market look at that and say, you know what? Let's try to go and look what happens if I try to sell everything and I bring the market down 10, 15% and then see what the Fed chair does. Is he willing to let the market go just because he doesn't want balance sheet expansion at the Fed or QE or stimulus? Let's test it out, right? So it may be a little bit of that component, but mostly I honestly think it's more of the potential uncertainty for what the new course will be at the Fed, right? Nothing more than that for me. Now, sure, we keep on having earnings projections being revised higher and higher. So again, that should be a positive thing for the market overall, right? Sure, then the market needs to live up to those expectations, but up until the point they're not disappointed, there's no reason to be particularly bearish the market, all right? Although, again, same as for the market breadth, when it comes down to where the real, profit margins increased are, it's mainly, in the Max 7. So you take the S&P and then you strip away the Max 7, you see that overall profit margins for the S&P minus the Max 7, it's pretty flat. So, we get back to the theme about these AI infrastructure build up, these gains being concentrated in just a few stocks, right? And the rest, it's kind of struggling a little bit, which over time creates what? A market which is structurally weaker, right? So again, it doesn't really look at that. If you think about portfolio, right? I mean, if you are diversified, right? Now, you may say, well, I mean, I'm expecting a little bit of weakness in the markets in general. I'm looking at the benchmark, right? So let's say maybe the S&P could be down 5%. Sure, the S&P, the index. But you are not owning the index, most likely. So probably you could be down more than the index. If the index is propped up by these 7 companies, but you are a responsible investor, so you don't own necessarily only these 7 companies, right? Maybe you own a lot of other different things for dividend yields, for value investing, or for protection, whatever. So the index being down 5% could mean your portfolio is actually down 10. So, the index never tells the story for your own personal portfolio or anyone else. It depends on how you structure that, obviously. All right. So just another thing to keep in mind. All right. I mean, overall, I think after a week like that, there is really not a lot to be discussed further. It's just, for me, right now, it's just this. I'm expecting the market to trade in between these highs and these lows up until the point I'm not told otherwise by the market itself. Obviously, I keep on maintaining a bullish disposition because, I mean, it's hard not to, but, a little bit less than what it was before. So I guess at a point, my thoughts as for last week has been confirmed in the sense that up until the point I was just, buy the deep, try to be long at all costs intraday, sure. At this point, I'm like, I still want to try to be long and to take longs or over short intraday, but, not blindly, so to speak. Now I need a good setup, right? And on the other side of the coin, now I might be also open to actually take short. Sure, of course, short term, you're talking, a few minutes, a few scalps, or maybe he's winging it on the short side, but for what? Intraday, so 30 minutes, an hour, who knows, right? Not talking directional short for the next week or 2 or 3 weeks of price action, but, overall, I'm expecting the market to be a little bit more volatile and offering opportunities both ways. So some sort of a two-tape market. Thing is that, I still think we should go up, but I want to wait for confirmations, essentially new all-time highs, right? Again, I want to see the market keep on going, right? Up until the point I don't see it, I might say, you know what, it's perfectly fine if we stay in this range, right? Because again, you look at the different indicators, right? They're all overbought, sure. RSI, stochastic, MACD actually giving you a sell signal. But remember, there are 2 ways a market can correct. Either by price, so a pullback, an actual pullback, price going down, or through time, aka the market going sideways for a little while, indicators resetting themselves, moving averages catching up, volumes being built up, a new structure being created at higher levels, so acceptance being, built up. And, after this pause, might be the market will keep on grinding to the upside. Obviously, always pay attention to the news because, it's a very headline-driven market. So there's always that risk. But, other than that, I don't see any reason to be overly bearish at this point. If anything, maybe a little bit less bullish, but God forbid you to be bearish this market at the current moment in time. Again, you would need to see the same things we've seen in this segment. Market slowing down, be unable to make new highs, moving averages starting to crawl back down, having a negative slope. So, up until the point I don't see it reflected in price action. Sure. Breadth, is it a problem? Sure. Market concentration, is it a problem? Sure. High valuations, are they a problem? Absolutely, over the long enough period of time. But next week? Maybe not, right? So that would be me for this week. And, I think that's more than enough. So I'm going to leave you off, wishing you a very good long weekend. Because remember, one tiny little thing, it's going to be Memorial Day on Monday. So the US markets will be closed. And again, if you think about that, could also be why we didn't have new highs this week. Sure, the technicals, we have been discussing them, but could also be that, look, a lot of institutions, right? Big guys, those holding the huge loads of cash, could also be that they didn't want to be massively long and to beat the market higher in this Friday, right? When they're going into a long weekend and they know they're not going to be able to trade on Monday. And throughout this long weekend, we are going to have discussions about the Middle East and potential oil movements. So could also be that why we didn't push to new highs on this Friday. We tried, and then it looks like a lot of people said, you know what? It was a good 2-3 days. Market went up. I'm fine with this. I'm going to hedge my bets, or I'm going to, close down my positions, and I'm going to get back to it on Tuesday. So could be another dynamic there. Remember, next week, we're going to have PCE and a few other things. Not a lot, but PCE, personal consumption, GDP on a Thursday. The rest of the week should be relatively calm, I think. Not a lot. So we should be safe on that front up until Thursday. And, other than that, there's really not a lot. Okay? So, as usual, be nice and be cool. Gonna check in next week. Nils out.
Mm-hmm. Mm-hmm. Mm-hmm.